Portfolio management formulas. There are 4 lines. First line is securities market line, SML. It is similar to CAPM. Formula is RF plus beta into RM minus RF, where RM minus RF is the risk premium, beta into RM minus RF is the market premium. Second line is capital market line, CML. RF plus sigma X divided by sigma M into RM minus RF. RM minus RF is the risk premium. Third line, critical line, Y equals to MX plus C, WY equals to MWX plus C. Fourth line, securities characteristic line, SCL, Y bar equals to beta X bar plus alpha. So, there are 4 lines. First line, securities market line, SML, it is similar to CAPM, capital market line, CML, critical line, and securities characteristic line, SCL. Next, there are 2 ratios, Sharpe ratio, Trainer ratio. Sharpe ratio, RM minus RF divided by sigma. Trainer ratio, RM minus RF divided by beta, where RM minus RF is the risk premium, sigma means total risk, that is systematic risk plus unsystematic risk. Beta means systematic risk. Jensen's alpha, expected rate minus required rate or KE. Expected rate minus required rate or KE. Required rate, how to calculate KE? RF plus beta into RM minus RF, or actual rate of return minus KE or required rate. Next one, coefficient of variation, CV. CV equals to sigma divided by X bar. Sigma means standard deviation, X bar means mean. Coefficient of determination, R square equals to systematic risk divided by total risk. Coefficient of correlation, RXY. RXY can be -1, +1, other than -1 or +1. If RXY correlation between 2 or more stocks is -1, then sigma P. Sigma P means the risk of portfolio equals to sigma X WX minus sigma Y WY. Optimal weights. Optimum weights WX equals to sigma Y divided by sigma X plus WX. WY equals to, that is weight of stock Y equals to sigma X divided by sigma X plus sigma Y. Next, if RXY is my +1, then sigma P equals to sigma X WX plus sigma Y WY. If RXY is other than -1 or +1, then optimal weights WX equals to sigma Y square minus covariance of XY whole divided by sigma X square plus sigma Y square minus 2 covariance of XY. How to calculate weight of Y? WY equals to 1 minus WX. These are the optimal weights if RXY is other than -1 or +1. Next, minimum variance portfolio, WX equals to, in case of minimum variance portfolio, how to calculate weight of stock X? WX equals to sigma Y square minus covariance of XY divided by sigma X square plus sigma Y square minus 2 covariance of XY. How to calculate WY? WY equals to 1 minus WX in case of minimum variance portfolio. Arbitrage pricing theory, APT. Arbitrage pricing theory, APT. Arbitrage pricing theory is plural form of CAPM, capitalistic pricing model. How to calculate arbitrage pricing theory? Required rate of return equals to RF plus beta 1 lambda 1 plus beta 2 lambda 2, so on beta n lambda n. Beta n lambda n is called as a risk factor premium. Price earning ratio, PER equals to MPS divided by EPS. E equals to M into present value minus future value. Next, calculation of beta. Beta means sensitivity calculation. In case of single stock, beta can be calculated in 5 ways. First one, when 2 years data is given, beta equals to change in stock return divided by change in market return. A regression analysis. By way of regression analysis, beta can be calculated as summation of xm minus x bar m bar n whole divided by summation of m square minus n m bar square. Third way to calculate beta is sigma x divided by sigma m into rxm. Rxm means correlation between x and m. Next, fourth formula, sigma x sigma m divided by sigma m square into rxm. Next, covariance of xm, divided by sigma m square. How to calculate portfolio beta? Portfolio beta equals to summation of beta W. W means weights. Next, sharp index model or single index model. As per sharp index model or single index model, a required rate of return equals to beta into Rm plus alpha plus E, where RR equals to required rate of return, beta means systematic risk, Rm market specific return, alpha company specific return, E unexpected error or error term. Generally E will be 0. Total risk equals to systematic risk plus unsystematic risk. Sigma x square equals to beta x square sigma m square plus Ex square. Beta x square sigma m square is called as systematic risk. Ex square is called as unsystematic risk. How to calculate portfolio risk? Sigma p square equals to summation of beta x wx whole square sigma m square plus Ex wx square summation. How to calculate random error? Random error equals to square root of unsystematic risk. Next, in case of single stock, how to calculate the return? Return in case of ex post data is given, in case if ex ante data is given. In case if ex post data is given, that means past data is given, then return will be annual return or holding period return x equals to P1 minus P0 plus dividend or interest plus capital gain divided by P0 into 100. Expected return x bar equals to summation of x divided by n. In case of ex ante data, that is future data is given, we will calculate directly the expected return. X bar equals to summation of xp. How to calculate risk in case of single stock? In case of ex post data and ex ante data. Ex post data, sigma p equals to square root of summation of x minus x bar whole square whole divided by n. Next, ex ante data, sigma p equals to square root of x minus summation of x minus x bar whole square into p. This is in case of ex ante data pertaining to risk. Next, in case of portfolio, how to calculate the return? Return of portfolio equals to summation of x into w. W means weight, x means return. Risk is of risk in case portfolio risk. How to calculate portfolio risk for 2 stocks, for 3 stocks? If there are 2 stocks, portfolio risk sigma p equals to square root of sigma x square wx square plus sigma y square wy square plus 2 sigma x wx sigma y wy, correlation between x and y. If 3 stocks are there, then portfolio risk equals to square root of sigma x wx whole square plus sigma y wy whole square plus sigma z wz whole square plus 2 sigma x wx sigma y wy rxy plus 2 sigma x wx sigma z wz rxz plus 2 sigma y wy sigma z wz ryz. Next, how to calculate covariance of xy? Covariance of 2 stocks. In case of ex post data, in case of ex ante data. In case of ex post data, covariance of xy equals to summation of x minus x bar into y minus y bar whole divided by n. In case of ex ante data, covariance of 2 stocks x and y, covariance of xy equals to summation of x minus x bar into y minus y bar into p, or sigma x sigma y rxy, or beta x beta y sigma m square. Next, other important points for doing the problems is, for diversification, there should be negative correlation between 2 securities. Positive correlation, perfectly positive correlation means 2 stocks are in same direction. Negative, perfectly negative correlation means 2 stocks are in different direction. Beta of risk-free securities is 0. How to calculate K R plus beta into R minus RF? K or RE means required rate of return or expected rate of return or equilibrium return. Equilibrium return. ER is also called as expected rate of return. Next, alpha. Alpha means expected return minus RE or KE. Alpha. If alpha is positive, stock is underpriced, buy. If alpha is negative, stock is overpriced, do not buy. Variance means total risk. Systematic risk means market risk. Unsystematic risk means company risk. Weights can be positive, negative, or greater than 1. In case of short cells, weights will be negative.